Hello everyone, I'm Muhib Faizi and I want to present three international pharmaceutical companies, CVS, Johnson & Johnson, Merk, with a 5-year financial overview, summary and analysis. Now I'm going to give the agenda for the three companies financial overview at the end investment decision. Now I'm going to describe the CVS financial overview and summary. So before that, I would like to start with the introductions of CVS. CVS is a health solution company which engages in provision of healthcare services. It operates through the following segments: healthcare benefits, health services, pharmacy, consumer wellness, incorporate, and other. CVS was founded by Stanley Goldstein and Ralph Hoagland in 1963. The headquarters is located on Woonsocket, Rhode Island, United States of America. So the CEO is currently David Joyner, and there are 300,000 employees working in this company. According to Robinhood, the market cap is $88.58 billion. Before dive to financial statements of CVS, so I'm going to describe four types of financial ratios. So the first is liquidity ratios are the ability to satisfy the company's short-term obligation using assets that can be most quickly converted into cash. Second one is solvency ratios. So this is also called debt ratios. These ratios describe company's ability to meet its long-term debt obligations such as bank loans, bonds payable, etc. There are two primary types of solvency: leverage and coverage. Leverage ratios focus on balance sheet, while coverage ratio focus on income statement and cash flow. The third one is the activity ratios. So, and they are assessing the efficiency of operations or business that analyze how well a company uses its assets and liabilities to generate sales. The last one is profitability ratio. So these ratios show a company's overall efficiency and performance. So this was the explanation of financial ratios. I'm going to present CVS profit and loss chart. Uh, as we see, the net sales revenue, so each bar represents 100% of annual revenue divided into cost and profit components. Regarding the cost of goods sold, consistently large portion reflecting significant production and operation cost. So as now we see, it's gradually increase over the periods of time. On the other hand, we see the gross profit, the remaining revenue after deducting the cost of goods sold, so changing yearly based on cost fluctuations. So now we see at the end of the 24 is quite lower over the period of time. We have two terms. We have EBIT and EBIT depreciation and amortizations. This both show the impact of operating expenses and depreciations, with earning before interest tax slightly similar than earning before interest tax, depreciation and amortization due to these each other deductions. So another part of the profit and loss is the interest expense. As now we see the minimal relative to revenue, indicating low debt servicing costs. So at the end, there is lower cost of the interest expenses. And the final element of the income statement is net income. So this is the smallest and the more volatile. As now we see, there is another small portion. So in totally their most volatile segment, fluctuating based on variable expenses in taxes. So the profit and loss uh, chart. So the high cost of goods sold is a major chunk of revenue goes toward direct production cost. Operating expenses is significant impact profitability beyond gross profit. And the lower interest cost is multiplies for debt related expenses. And at the end is variable profitability. Net income percentage vary year to year, highlighting changes cost structure or financial management. So this were about the profit and loss. Now I'm pointing out the balance sheet of CVS, which is financial position of 5 years. So now I'm beginning with the current assets. So the current assets is fluctuated slightly and it's ending slightly higher by 2024. So this is reflecting minor growth in short-term liquid assets. As now we see the fixed assets, on the other hand, is showing a clear upwards trend, reaching about 110 of the base year of the 2024. So it's give signal increase investment in long-term assets. And the other aspects of both current and non-current assets. So it's followed the growth in fixed assets, showing an overall rise in CVS asset base of 2024. Now I'm forwarding to current liabilities. Current liabilities is consistently increased. We see here the charts. So this is showing rising short-term obligations. So on the other hand is non-current liabilities, means long-term liabilities is varied year to year but ended higher than the starting point, reflecting mixed changes in long-term debt. And overall total liabilities is growth overall, as we see here, and this was driven by increase in current liabilities and fluctuations in non-current ones. So this is all about the total liabilities of the CVS. Now I'm going forward to the owner equity, which is displayed a steady upward trend and marking an increased value for shareholders. In totally, the owner equity in liability is matched total assets consistently, which confirm balance sheet accuracy, as we see this part of the balance sheet. An overall observation of the financial position of CVS is asset growth, which is significant investment in fixed asset has boomed overall asset value. And regarding the rising liabilities, both short and long-term debts have contributed to increasing obligations. And the last one is growing ownership value. Shareholders' equity has consistently rising, reflecting better returns or retained earnings. So this is balance maintained. The alignment of total liabilities in equity with the total asset confirms adherence to accounting principles. Now I'm giving heads up to financial issues of CVS. I'm going to begin with the working capital. So it's as we see that all year the 5 years are negative and worsening. So it gives a signal that the CVS struggles to meet short-term debts. And look at the current and quick ratio is the strength is also below 1, and it means that the insufficient liquid assets to cover liabilities. So this is a kind of instability and insufficient to cover short-term liabilities. Now we see the cash ratio is the extremely low, see nearly fluctuating and nearly to 0, and even in this year is negative. So it means there's minimal cash available for obligations. Look at the debt ratio. So the debt ratio is slightly increasing in through all the years to 70%, and it's reflecting substantial reliance on debt financing and heightened financial risk. So another point is that the equity ratio is it rising from 2.04 to 2.34. It means there is significant financial leverage and vulnerability. So this both times earned and cash coverage ratio generally positive but dropped, as we now see this both in 2024. So this ability to manage interest payments, the ability of this interest payment is reduced. And overall observation is the weak liquidity we have, high leverage, and the debt coverage is declines in trust coverage ratio in 2024, which suggests weakening capacity to manage obligations. Let's look at another type of activity ratio. So now I'm beginning with account receivable turnover ratio. Now we see that declining from 2020 to 2024 is around about 10.40. So it shows slow receivables collections. Now we see that days sales in receivable ratio means that kind of increasing from 27 to 32 days. So it means that the longer payment collection times. Another, if you look at the inventory turnover ratio, so it's a kind of rising from 14 to 20. So it's showing the improved inventory sales efficiency. Is days sales of inventory ratio. So it decreasing from 31 all over to 21. So it reflecting quicker inventory turnover. Look at another accounts payable turnover is gradually declining from 6.61 to 6.08. So it's suggesting slower supplier payments. Look at another day's cost of sales in payables is exponentially low, consistent from 4 even though to 3. So it's raising concerns about payment practices. Look at total asset turnover. As now we see in 2023, it's peaking at 1.5 before slight drop at 1.48 in 2024. So it shows generally improving in asset utilizations. And the fixed asset turnover, so this increasing steadily to 2.08 in 2023 before minor decline to 2024. So it representing better efficiency with fixed assets. If we look to the final part of activity ratio is working turnover ratio. As this is negative because of the before, as we said, as we saw, the working capital is quite negative and unable to cover short-term obligations. Now I am pointing out the last part of CVS financial ratio is profitability ratio. So beginning with the gross profit margin is declining over time. If you look at along the 2020 to 2024, so it's suggesting rising cost of goods or competitive pricing pressure. If you look to the net profit margins, is high volatile and dipping in 2022 if you look at, and 2024 due to increased operating costs, interest or taxes. we look at the operating profit margin gradually trending downwards. So it means challenges in managing day-to-day costs. Another is return on assets. So return on assets was lower in 2024 compared to earlier years, showing reduced profitability from asset usage. If you see the return on equity, similar to return on investment, with dips in 2022 and 2024. It reflects concerns for shareholder returns. If we look to the last part of the profitability ratio is sales fixed assets. So it's a steady upward trend. So it signals improved efficiency in generating sales from fixed assets. And in overall, if we look at the profitability ratio is shrinking margins, a declining gross and operating profit margin highlight increased cost pressures or inefficiency, inconsistent returns, volatile net profit, return on assets, return on equity suggest varying impacts from operation and non-operation expenses. Improved asset utilization, the upward trend in sales to fixed asset ratio is positive sign of operational efficiency. So now I'm presenting the second pharmaceutical company, which is Johnson & Johnson Financial Performance Analysis. Now I'm starting with the introduction of Johnson & Johnson Company is a holding company which engages in research, development, manufacture, and the sale of products in the healthcare field. It operates through the innovative medicine and medtech segments. Johnson & Johnson was founded by Robert Wood Johnson I, James Wood Johnson, and Edward Mead Johnson Sr. Currently, the headquarters is located in New Brunswick, New Jersey, and currently the CEO is Joaquin Dauto. There are 138,100 employees are working in the Johnson & Johnson company. Let's look at the profit and loss chart. As we see, all this revenue base each year start with the 100% of revenue. Subsequent segment show percentage of cost and profits. Now look at the cost of goods sold. Takes a significant fluctuating chunk of revenue in impacting profitability. If we look at the gross profit, so revenue lift after covering cost of goods sold moves inversely to cost fluctuations. And look at the earnings before interest, tax, depreciation, and amortization, and after deducting the non-cash expenses is slightly smaller due to additional non-cash costs. The non-cash costs are depreciation and amortizations. If we look at the interest expense in total is a minimal portion of revenue, indicating manageable debt servicing. And the last part is the net income, which is the standard net income percentage in 2023. If we look at these portions, suggest unique factors that increase profitability that years. So in overall, cost pressure fluctuations in cost of goods have a noticeable impact on gross profit margins. Operating costs matter. Expenses reduce gross profit, showing their effect on core operation earnings. Stable interest expenses. So the debt management appears effective with interest costs consistently small. And lastly, variable profitability shifts in net income suggest external factors influencing final results, especially in 2023. So this was about the profit and loss chart of Johnson & Johnson. Here is the summary of balance sheet of Johnson & Johnson, and there are the compositions of the balance sheet. So the first composition is the current assets, hover around 20 and 25%, so showing minor fluctuation across all the years of the current assets. If you look at the fixed assets in total, this is the largest asset category, consistently 35 up to 45% of total assets. So though slightly decreasing over the time. So another composition of the balance sheet is the current liabilities. The current liabilities are kind of stable, 15 up to 20%. So it's indicating consistent short-term obligations. If you look at the non-current liabilities, is about 25 up to 30% of total liabilities, with minor fluctuations around the period and years. If we look at the shareholders' equity, so that's around fluctuating between 25 to 30%, and it's reflecting the owner's stake in the companies. And overall, stable financial structure is kind of relative proportions of asset, liabilities, equity have remained consistent from 2020 to 2024. As we saw, fixed assets as a focal point. Those dominate the asset base, emphasizing long-term investments. Now, if you see balance financing, the chart highlights the steady mix of liabilities and shareholders' equity as a funding sources. So, yearly variations, small fluctuations reflect shifts in business activities or financial strategies. This was all about the snapshot of balance sheet of Johnson & Johnson. Let's look at the financial issues. So, I'm going to dive for working capital. So, as you see, working capital fluctuated and turning negative into 2022, again recovering in 2023 and decreasing in 2024. If you look at the current ratio and quick ratios, so this current ratio is dropped below 1 and again recover in 2023, but overall there is challenges in liquidity. If we look at, so the remaining week overall, if we look at the cash ratio, so the cash ratio is peaked in 2021 slightly, but declined significantly in 2024. So it's highlighting limited cash to cover short-term liabilities. We look at the debt ratio. So the debt ratio is gradually declining from 62.30% to 58.96%. So it gives the signal to reduce reliance on debt to finance assets. If we look at the debt to equity ratio is stable during all over the years. And lastly, if you look at the times interest and ratio, cash coverage ratio, so they decline sharply, indicating weakened ability to cover interest obligations, particularly in 2023 and 2024. This was all about the liquidity ratios and solvency ratios of Johnson & Johnson. So there is another type of ratio, which is activity ratio. So I'm going to start from account receivable turnover ratio. If you see that that's the stable between 5 to 6 in showing consistent efficiency in collections. If you look at the days sales and receivable is quite steady in the low to mid 50s, indicating that a predictable average collection period. If you look at the inventory turnover ratio, so that's gradually decline to 7.21, So it's suggesting decreasing inventory management efficiency. We look at days sales of inventory ratio is from 162 days to 231 days. It means that the Johnson & Johnson increased holding period from these days and tying up capital. Look at the accounts people turnover. So fluctuates, but average is around 1.85 to 2.26. It's hinting at slower supply payments. We look at the days cost of sales and payables. So that's the cycle. This is the short-term payment cycle between 11 and 14 days. Another is total asset turnover. So it means the stable between 0.46 to 0.54. So it means that it's generating 46 to 53 cents in sales per dollar of the assets. If you look at the fixed assets turnover, similar, ranging between 0.67 and 0.77. So it's reflecting efficiency in using fixed assets for sales. And finally is working capital turnover, volatile with a notable negative value in 2022. So and then high positive in 2023 and 2024. So this was all about the activity ratio of Johnson & Johnson. The final financial analysis of Johnson & Johnson is for profitability ratios. So now I'm going to dive into gross profit margin. So increasing overall, peaking 78.3% in 2023, then slightly dropping 77.9% in 2024. So it gives reflecting improved control over direct costs. We look at net profit margins. It's volatile with sharp rise in 2023. So it's likely due to one-time gains followed by steep decline in 2024. If we look at the operating expense profit margin, so it's stable with slight upward trend until 2023, then decreasing in 2024, indicating potential challenges in maintaining operational efficiency. So if we look at return on assets, so both return on assets and return on equity, so similarly both fluctuate similarly, peaking in 2023 and then dropping significantly in 2024, highlighting volatility in profitability and shareholder returns. And the final is sales to fixed assets, relatively stable between 4.01 and 4.60, with a slight decline in 2024. It is suggesting consistent fixed asset utilization. So this was all about the financial analysis of Johnson & Johnson. So now I'm going to dive the last company of financial performance analysis, which is Merck. Merck is a healthcare company which engages in the provision of health solutions through its prescription medicines, vaccines, biologic therapies, animal health, and consumer care products. It operates through the following segments: pharmaceutical, animal health, and other. It was founded 1891 and the headquarters is Rahway, New Jersey, United States of America. So currently the CEO is Robert and Davis and 75 6,000 employees are currently working in the Merk company. Let's look at the profit and loss chart. As you see, this is the net revenue is representing 100% of annual revenue and serve as baseline. So if we look at the cost of goods sold on this side of the chart is a stable percentage of revenue, it taking a significant share each year. So on the other hand, if you look at the gross profit, which is light green bar of the chart, is showing consistent as percentage of revenue, showing a stable core business. If you look at this both operating income and expenses, this both is due to varying this both charts. As we see, operating expenses heavily influenced by R&D and marketing. So total interest expense is, on the other hand, is if we look at that, it's this bars which is very low relative to revenue, and it's indicating a low debt burden. The last is net income. So the most variable, this is the net income chart each year. So if we look at the most variable reflecting changes in expense and taxes and other factors, so it's notably high in 2024. So this is all about the profit and loss of Merck company. Now I'm going to look at the summary of Merck's balance sheet trends. As always, I'm going to start from current assets. As you see, the current assets fluctuating with a significant increase in 2024. As you see, the fixed assets is very rate year to year, dipping in 2023 and recovering again in 2024. If we look at the total assets, which is the sum of current and non-current assets, it's gradually overall growth reflecting combined changes in current and fixed assets. So if we look at the current liabilities, consistently rising and showing growing short-term obligations. The other hand is current liabilities, which are kind of fluctuating and peaking in 2022, dipping in 2023, and again slightly increasing in 2024. And totally, liabilities is increasing overall, led by growth in current liabilities and variations in non-current liabilities. So at the end is stockholders' equity is a kind of significant growth, especially in 2024, indicating a stronger ownership stake. So at the end is total liabilities and equities of the balance sheet. So mirrors total assets, confirming that the balance sheet aligns with the accounting equations. So this is all about the snapshot of financial position of Merk. Let's dive into financial ratios. If you see the working capital is positive trend, growing significantly from 20 until 2024. So it indicates a stronger short-term financial health. If we dive into current ratio is a kind of consistently above 1 each year, and it's a peaking at 1.47 in 2022 and remaining healthy in 2024. So if we look at quick ratios, so quick ratio is lower than the current ratios because of typically for inventory heavy companies, peaking at 2022 and recovering in 2024. If we look at the cash ratio is fluctuating low values, negative in 2020 and 2023. So it's suggesting a reliance on other current assets beyond cash to meet obligations. So if we take a look at the debt ratio, so debt ratio improved from 2020 to 2024. So all along the years, the debt ratio has been improved. So reflecting reduced reliance on debt financing. If we see this debt to equity ratio, so it declined from 20 to along to 2024, so it indicating a reduced financial leverage. So in times interest ratio is another kind of solvency ratio, is a strong ability to cover interest expense. It was peaking in 2022 and remaining robust in 2024. And the final is cash coverage is high, consistent, peaking in 2022 and staying healthy in 2024. So this was the two types of ratios. So now I'm going to dive into activity ratios. I'm going to start from account receivable turnover ratio. So in 2020, the account receivable turnover ratio was quietly decreasing. It means that it's uh, decreasing the sufficiency of the companies to collect from account receivable. So the second is days sales in account receivable ratio. So the stable range from 54 to 66 days, and in 66 days in 2020 was the slower collection, but improving in 2024. As we see, there is another inventory turnover ratios. It means it was rising from 2020 to 2024. So it means indicating enhanced inventory efficiency. As now we see days sales of inventory ratios, so it was increasing from 231 days to 213 days. So it means aligning with faster inventory turnover. Another is accounts receivable turnover. So it's fluctuating between 21 and 2022. So this indicating variability in supplier payment frequency. So now we can see this cost of sales and payable ratios. It's a quite exponential low, and it's the average number of days it take Merk to pay its suppliers. Another is a total asset turnover. So total asset turnover is low but improving, range between 0.49 to 0.57. So reflecting modest efficiency in generating revenue from total assets. Fixed assets turnover is rising slightly, 0.72 along all to 0.484. So it means showing better utilization of fixed assets. The last is the activity ratio is working capital turnover. I see high volatile from high of 2020 to 2024, which is lower, so indicating fluctuating working capital efficiency. So this was about the activity ratios. So now I'm going to dive in the last part of financial ratios, which is profitability ratios. Gross profit margin is strong, ranging from 2022 to 2024, which is slightly deep in 2022. As we see that it's a notable decrease in 2024. It's reflecting improved cost control to pricing strategies. As we see now, the net profit margin is volatile and it's peaking and 2021 and significantly dropping in 2023 because of factors beyond core production costs. As we see, another is operating profit margins positive overall, fluctuating between 2023 and 2024. So it's suggesting variability in operating cost management. As now we see return on assets is high in 2022, but with a sharp dip in 2023, highlighting asset profitability concern in that year. So return on equity is another ratio of the profitability, is a mirrors of this return on assets, which is peaking in 2021 and 2024, but a significant drop in 2023. So the last one is sales to fixed assets. It's a stable range between 1.41 and 1.87. It's indicating consistent efficiency in utilizing fixed assets to generate sales. This was all about the financial issues of the Merck Corporation. Finally, I'm here on the investment decisions. So now I'm going to key financial analysis regarding the investment decisions. So whatever you guys choose the investment decision, it's up to you. So regarding CVS, expect the company's profits might not be stable or predictable from year to year. Johnson & Johnson rate at which the company's key financial metrics are increasing is likely to be slower compared to other companies, or compared to its own historical performance during periods of higher growth. Regarding the Merck's investment considerations, past net income volatility, expect profit swings, not always a steady growth. Drug development risk means high costs, failure, long timelines, regulations, patent issues, and inherent in the industry can impact Merck's financials. In bottom line, be prepared for potential ups and downs due to the nature of the pharmaceutical business and Merck's past performance. And the next slide is my work cited that I gathered the information. So thank you guys for watching my presentation.